Yep.
Okay, so you can see both the screen and me. Okay. I always like to kind of at least be present so you're not just hearing some rando voice, right? Coming at you from nowhere. So I appreciate that. Yeah, I'll go ahead and jump in here. Again, my name is Lonnie Stewart. I'm a national account manager at F&G. At F&G, our bread and butter is annuities. We also do IUL, life insurance. That's going to be more Larry's side. I'm the annuity specialist. So today we're going to concentrate on annuities, specifically FIAs or fixed indexed annuities. What I'll do here is I'll walk through, first and foremost, as Wyatt kind of mentioned, I'll give us like a 20,000 foot view of exactly what they are, what they do, how they can be utilized, things like that. And then we'll get a little bit more granular in regard to a couple of product examples, what they do, and how they can be utilized. And if you were on here earlier, both Wyatt and Hassan were absolutely correct that if you're not tapping the annuity business side in regards to your sales, you're really missing out. It really is what can take your business compensation and success to the next level in regards to just making that money, right? So first off here. As I kind of mentioned here, really why FIAs, what are they, why now, what are the benefits of the annuities? And as I mentioned, we'll get into a couple of our solutions, i.e. product, to kind of see, how the inner workings of them, how we can use them. And then towards the end, a couple of examples of some of the marketing pieces we have, which we can provide that afterwards. Our internal sales team, wholesaling team that can help you out. They're great, and they're great to utilize, whether it's your first app or you've been doing it a long time. Okay. So first off, just briefly about the company, our mission, we help people turn their aspirations into reality, particularly in regard to financial strength, and in regard to getting folks financially set for throughout their lives and on into and through retirement. Okay. Uh, we've been around and been doing it a long time. We have almost at this point 1 million people protected. We have well over 1,000 employees. Our headquarters is right here in the upper Midwest in Des Moines, Iowa. That's where I'm located. So very strong local company. We are A-rated. Obviously, that is very important when choosing an annuity carrier. As you all know, an insurance product is basically a promise. And that promise is only as good as the backing of the company. Outside of that, it's no better than the piece of paper that it's written on. So you always want to make sure you're hopefully working with a rated company. We have over $50 billion under assets under management. We have been growing very rapidly over the last few years. I think that speaks volume to the competitiveness of our annuity product. The importance of annuity products in the market right now, in general, how they are just competitive, period, due to the interest rate environment, which I'll speak a little bit to. And then, of course, our service model in regards to the ease of doing business as well. All of those in combination, we have been growing in leaps and bounds and are going to continue to do so in the years ahead. So why FIAs and why now? Starting off very basic here, let's just talk about what a fixed indexed annuity is, right? An FIA, otherwise known as a fixed indexed annuity, is a contract with an insurance company that offers the potential for growth based on the performance of a market index, similar to the S&P 500, while also guaranteeing your principal. So that means no downside risk. Okay. And it's a longer term saving option that can possibly provide a stream of income when folks get to the point of retiring. Okay. So looking into this a little bit more granularly, It's, as you see, there's potential for growth, tracking a market index. Couple important words there. Potential, which means it's not going to be a guaranteed return, like say a MIGA, a fixed annuity, or a CD or something like that. It's going to be dependent on market returns, okay? And as I mentioned, it's linked to a market index like the S&P 500 or something similar. When I say linked, we're not actually investing the money into the S&P or the equity markets or the stock market in and of itself. That's how we're able to provide no downside risk, okay? So these products are going to have more upside potential versus more conservative sort of investment opportunities, like just putting it in a savings account in the bank, maybe buying a CD through the bank, purchasing bonds, purchasing a fixed annuity with a guaranteed interest rate, which would be lower, things of that nature, and still offers no downside protection, that folks cannot lose money when they're placing money into these. Okay. So a lot of this I just kind of walked through here. Um, Guaranteed initial investment will never be lost. And then also, as interest is applied to the account, that also cannot be lost. So the money is always guaranteed. Not to get too far down to the weeds in it, but how are we able to do that via index linked growth potential? What we're doing is we're purchasing options from investment banks. Basically, what an option is an investment bank will sell us an option for, let's say, 3%. And they will say, hey, we will offer you S&P cap for 1 year of 9%. If the S&P 500 returns in that year, we'll give you that return up to a maximum of, say, 9%. If the S&P is down, then the client makes no money, and the investment bank keeps that 3% that we paid for the option. So us as the insurance carrier, we're not keeping the money if the client doesn't make anything for the year. We're simply investing and purchasing an option from an investment bank. That's how we're able to offer index linked returns like the S&P 500, and also guaranteed no downside. If the markets take a turn, we have something terrible like the recession happens, a great recession or another recession, dot-com bubble and burst, things like that. We're able to guarantee no downside loss, okay? In addition, these products do offer tax deferred growth, basically meaning that clients won't pay taxes on what they're making until they start taking withdrawals out of the annuity and taking possession of the funds. So basically, if they're allowing it to grow for several years, and then whether they're approaching retirement or they move into retirement and then they start taking withdrawals for their retirement, then it is reported as taxable income. That's a very big benefit within these products. A lot of other products like CDs and other safe money assets, as they're earning interest, they're having to pay interest on that in the same year. That is not the case with these sorts of products. They're not paying taxes or reporting income from these until they're actually taking withdrawals. So that's a big benefit for these, okay? In addition, if anything ever happens to the owners, the cash value is always going to be afforded to their noted beneficiaries of the contract. Okay, it's not going to go through probate. It's a very simple sort of procedure where we note the beneficiaries when we issue the contract. If anything ever happens to the owners, the beneficiaries receive the money that's in them. So very simple in regards to passing money on if something were to happen to the owners, okay? In regards to the products, annuities, specifically fixed indexed annuities, why now? Basically, annuities are more competitive in higher interest rate environments. Essentially, we're able to offer higher caps, rates, things like that, which we'll get into a little bit more here as I walk through it. The higher the macroeconomic interest rate environment is, which basically that means right now we're in a little bit higher of an interest rate environment. That means that the products are very, very competitive right now. That translates into more opportunity for gain, for making interest and gains on them, or with a different sort of product, which we'll talk about, which is a guaranteed income product that can also translate into higher income when they retire. Okay, so now is a great time due to competitiveness. In addition to a lot of folks are looking for some safety right now because a lot of the ups and downs of the market. Okay. So as I kind of mentioned here, what types of annuities, quote unquote, are offered? The most simplest form of them are called multi-year guarantee annuities or MIGAs. Those are going to act very similarly to like a CD. There's going to be a fixed interest rate. However, it does not offer as much upside potential as what I'm referring to here with fixed indexed annuities. Even with very high competitiveness in the markets right now and with higher interest rate environments, MIGAs, multi-year guarantee fixed annuities, are going to pay somewhere in the 4 to 5% range. Even just a few years ago, when interest rates were lower, these were paying more along the lines of about 3%. So they're going to be more in line with like a CD or a bond or something along those lines. Fixed indexed annuities, on the other hand, which we're talking about today, which are linked and tracking indexes, they're not going to be paying out a guaranteed interest rate. However, there is more upside potential, as we'll see here in a little bit when we look at a product. You can make up to, depending on the return of the markets, anywhere from 6, 7, 8, 9%, or possibly even more in a given year, which is very fantastic considering there is no downside loss potential either. Okay. The other thing we'll talk about here briefly is, besides making interest and money on fixed indexed annuities, making return, there are also a subset of FIA annuities that provide something very important called a lifetime guaranteed income. Okay, so there's basically two sides to the annuity coin here. One side is going to be safety and accumulation, and the other side is going to be lifetime guaranteed income, which, as you would probably suspect, is going to be geared a little bit more towards folks approaching or entering the retirement phase of their life. Okay, so it's something we'll talk about here a little bit. We're pretty excited about it because a lot of clients out there just don't even know something like that even exists, and we'll speak to that here a little bit shortly. So every year for about the last 4 or 5 years now, F&G has completed with a third party a risk tolerance tracker study. And basically what this is saying is, hey, this is a study of random folks of how are you feeling right now in regards to your finances, the economy in general, what are your concerns, how optimistic are you about how things are going. The most recent one we did here, basically, despite, there is an overall fairly optimistic look of the economy in general. However, a lot of Americans are reporting concerns over things like inflation, the politics, whatever your political persuasion is, geopolitical risks, interest rate risks, things like that. So basically, folks are looking for a little bit of safety instead of just unlimited upside and unlimited downside as well. Okay. So with that said, only 14% of all investors currently own an annuity. Okay. 91% of respondents, when they're looking to move towards or enter retirement, they're obviously pretty straightforward, looking to maximize their income. They're thinking they do that via their Social Security, or if they have a pension with their job, which they probably don't because that's very rare these days, mostly Social Security. A far majority, 88%, they're going to prioritize having an income for life, which we'll talk a little bit about. And a majority of folks are looking to protect against inflation, as we've seen that happening a lot here over the last couple of years. So what this slide here says is that the long and short of it is that folks want, well, what annuities provide. A far majority want the benefits of annuities. However, a very small percentage, only about 14%, actually own annuities in the marketplace. So what does that mean? That means a huge opportunity for you. Okay. In addition, 58% of investors are not working with any sort of financial professional, advisor, etc. Again, what that tells me is that that is a great opportunity for you. Percentage of respondents who are not working with a financial professional, it's pretty even across most of the generations. Boomers, Gen X, millennials, everyone. It's hovering right around 50% or a little above. Everybody needs and wants the help of a financial professional or of an advisor such as yourselves. Most people just don't have one. Again, this is saying a great opportunity for you. Okay. So how can annuities help address these sorts of challenges, whether it be in retirement, nearing retirement, or just concerns about inflation, markets going up and down, things of that nature? With these sorts of products, there's good growth potential in them, as I mentioned, which we'll look at a little bit more in depth here in a bit. There are some great that basically the downturn guarantees. Basically, what that means is I already mentioned you can't lose money on them, which is fantastic. And if you're looking for it, you can create yourself a steady stream of income when you do retire. Okay. So first, let's look at the safety and accumulation side of things. Again, as I mentioned before, there's kind of two sides, and I'll repeat it again. There's kind of two sides to the coin with annuities. There's safety and accumulation, and there's lifetime income when you're ready to retire. Okay, so let's look at the safety and accumulation first. These basically act as sort of investment vehicles, even though they are insurance products, they act as investment vehicles in the regard that they can provide returns for clients while guaranteeing or protecting them from downside loss. Okay. As you can see here, even just over the last few years, the markets in general, whether it be the S&P 500, the Dow, NASDAQ, whatever, there have been several downturns, basically just since COVID happened, right? There has been 5, 10, 15, even 20% downside losses in the markets just in the last few years. We know it's going to happen. We know it's happened in the past, and we know it will happen again. For a lot of folks that are looking for some safety in regards to their investments, this is something where we can help them out to alleviate this happening again, right? Another thing to note is that when these downturns in the markets do happen, and say that they're in a 401k, that's typically going to be in markets, equities, stocks, things like that. When there is a downturn, a lot of folks just kind of in general think, okay, well, if I lost 10%, I need to make 10 to get back to where I was. Or if I lose 20, I need to make 20 to get back to where I was to recover my loss. That is actually not true. Okay. You actually need to make more just to get back where you were because of the downturn in the market. As an example, if the markets are down 20%, so a client's 401k or investments may be down 20%, they need to make 25 just to get back to where they were even before they even get back into the positive. If there's a large recession again and they're down 30%, you're talking about 42, 43% they need to make just to get back to where they were, which can sometimes take years and years to accomplish. Okay. When we had the dot-com boom and bust back in the early thousands, and when we had the Great Recession in the 08 area, both of those happenings took approximately 6 to 7 years to get back to where they were before they, and back into the positive. For some folks, they don't want to wait that long, or if they're getting towards or close to retirement, they don't have that long to make their money back before they slide into retirement and start spending down their money. Okay. I like to show this piece here as it is a great example of how annuities and index annuities in and of themselves work. Basically, what this is showing here is it's putting an annuity up against the S&P 500. What it's showing here is that the annuity is never going to have a loss, right? As I've mentioned, it's never going to go down. It's going to be more steady or flat growth all the time, no downside. Now, as you can see here, the green line, which is going to be your S&P 500, it does tend to grow more over time. However, we're not saying here that an FIA is going to outgrow or outperform the S&P 500 over a lengthy amount of time. What we're saying is that we're taking some risk off of the table for folks that are looking to de-risk their portfolio, their investments, their 401ks, their IRAs, things like that, so that they're not open to large losses. Okay, so this is a great piece that just shows kind of how they work, steady growth, and no downside. So with that said, in regards to safety and accumulation of that side of the coin of an annuity, let's take a quick look at one of our options and how that works in terms of safety and accumulation. We do have a product called the Performance Pro. And what that does is, first of all, it will give a large bonus up front for any premiums that are put into it, up to including 15%, depending on their age and what state they're in, typically 15%. Okay. So a large bonus up front. There's also going to be strong upside potential in regards to what they make in interest over time, much more upside potential versus, again, more safe money options like just having it in the bank or having, owning a CD or something like that, much more upside potential. Okay. And then there's also possibilities again for guaranteed income that I mentioned. So again, the name of the game with the Performance Pro is going to be safety and accumulation. Okay. Basically, what we can do, I know there's a lot of information and numbers on this, but just to keep it kind of simple here, we can write this product up to and including age 80. Okay. Even though it is an insurance product, there is not underwriting per se. They cannot be denied purchasing a product like this because of underwriting. Okay. So basically, they're just putting the funds in and it's treated very similarly to like an investment. Okay. There's a $10,000 minimum to it. And it's also called flexible premium, which means that funds can be added to the product even after it issues. So folks can add to it for their retirement. Okay. $10,000 minimum, $2,000 additional premiums. With these annuities, there's going to be a time frame to it. We call that a surrender schedule. Most products are going to have surrender schedules in the area of approximately 10 years, okay, which is typically suitable because these are the type of products that folks are utilizing to save money, to save for their retirement. And so it's okay that they're not going to, similar to their 401s and other things, it's okay that they're not going to touch it for several years. Once the 10-year surrender schedule is over, then they're able to access it whenever they want. During the surrender schedule, they're able to access up to a 10% per year withdrawal rate. Okay. In addition to that 15% bonus, there's some very strong upside caps to it, which we'll take a look at in a moment here. There's also going to be access to it if folks are retired and they're having health concerns, where we will strip away that surrender schedule and those surrender fees within that 10 years if they're having any sort of terminal illness, nursing home health care, things of that nature, so that they have access to their funds when they need it most. Okay. So with that said, you may or may not be aware of some of the annuity products out there similar to this. that do have some bonuses included with them when clients purchase them. Ours has a 15% bonus. There are some annuity companies, carriers out there that do offer higher bonuses. As you can see here, competitor A, competitor B, those are real competitors and actual competitor products. As you can see there, their bonuses are noted as high, or 20 and 22%. However, we have to be very mindful here that there are some costs and fees involved with these products. As you can see over to the right there, our product has a 0.1% annual fee, whereas the other two fees are significantly larger at 0.95% and 1.20%. With that said, even with a larger bonus on those other products, over time, clients are going to be paying significantly more dollars in fees. So they're actually going to come out ahead with our lower bonus because of the significantly lower fees. So what like to call this is sometimes when less is more, right? So when you're selling these sorts of products that do come with an upfront bonus, one, you need to know if there is a fee involved. Two, you need to know what that fee is. And three, you need to be comparing those fees, because even though there's a larger bonus involved, it may not be the best fit for your client due to fee erosion. Okay. So another one marketing point I'd like to kind of point to here: where are we looking for clients that would utilize these products, right? Let's kind of get down to where you would be looking for and utilizing these among your clients. One great example would be folks that have recently seen some downturn in some of their investments, whether it would be a 401k, which would be most likely, or any other sort of investments. As we know recently, there have been some up and downs in the market. A lot of folks, sometimes that gives them a lot of heartburn. They're looking for some safety, and this is something to where you can step in and help them out here. Not only if they have had some loss recently, let's say 10% loss, 15% loss, something like that in their investment, you can transfer these funds over to the annuity, the fixed indexed annuity, the FIA, and you can give them that big bonus up front. So basically, you are helping them recover from their losses. You're giving them their losses back. So that's a great first start. On top of that, you're giving them their downside protection so they can't lose money anymore. And two, you're giving them good upside potential for growth in regards to making interest. So that's a great marketing or sales pitch for folks that really are worried about possible downturns in the markets. Possibly they have left their job and there's an old 401k sitting out there. I had several folks at our event in Phoenix last week mention that to me, that some of their clients had changed jobs. They had a 401k, they needed to do something with it. We can directly transfer dollars from those sorts of assets, 401ks, into these annuities. And it doesn't cause any sort of penalty or taxable event or anything like that. Okay. So a great couple of ideas in terms of how you could have these conversations with your clients and the sort of clients that would maybe want to utilize this sort of product. Okay. So let's take a little more closer look in terms of how these things grow. Okay. There are going to be several options out there. Some of them do get down in the weeds a little bit, but I'm going to try to keep it as simple as possible here, at least in the beginning stages. As I mentioned, since it's a fixed indexed annuity, it's not going to be a guaranteed rate of interest, like 3, 4, 5% interest. It's going to be dependent on the returns of the market. Okay. So what does that mean? Let's just look at the most simple example of what that would mean for growth. Okay. One option we have is the S&P 500, and it would be called an annual point to point with a cap. Okay. What does that mean? That means that if we issue the contract, let's say on June 1st, we would take the S&P 500 reading on that day. Next year on June 1st, we would then take the S&P reading again, and whatever that gain is in that year from anniversary to anniversary, we would calculate the return as a percentage, okay? And then that percentage would be granted as interest to the client up to a stated cap, okay, which we'll look at here in a moment. There's going to be things like caps involved because you can't have no downside risk with unlimited upside potential, right? Because if so, that's something that everybody would be in that product in the market, okay? So let's take a closer look at that. Okay. Down below there, S&P 500 1 year point to point. There's with our Performance Pro, where you get a large bonus up front, there is a 6.5% cap of what you can make per year. Okay. So again, if we issue it on June 1st of this year, June 1st of next year, let's just give some examples here. Let's say the S&P and between anniversary to anniversary, let's say the return is 5%, the client will get 5%. If it's 6, they get 6. If it's 7 or 8 or 9, anything above that 6.5, they still get that 6.5% cap. Okay. So again, more upside potential versus some fixed things, assets like your CDs, banks, things like that, with the same sort of downside protection. There's no loss. As an example, let's say the S&P had a down year, okay, and then let's say it was down 5%. Yes, the client does not get any return for the year, it would be a 0. However, they're not losing any money. It would just simply be a 0 return for the year. That's what we would refer to as a 0 is your hero year, right? Again, this is going to be geared more towards folks that are looking for some safety in regards to downside protection. And this is exactly how this is provided. Okay. So good upside potential for return as an investment and no downside risk. Okay. There are some other options here outside of the S&P 500. We have some things like participation rates, things like that. A lot of these things are going to be a mix of certain things. They act sort of like ETFs or exchange traded funds. One example would be that balanced asset 5. That's going to be more of your traditional 60-40 split between equities and bonds. Okay. Again, subject to a 1 year point to point. And what does a par rate mean? That stands for participation. That means whatever the return is, the client receives 140% of that return. So if the return for the year is 10% on that particular option, the client would receive 14%, 140% of 10%. Okay. Another option would be gold, the gold commodity there in the middle. Obviously, as a lot of us know, gold has been returning very well over the last few years. It's been capping the last few years. Again, a 1 year point to point. We take the gold reading at anniversary and then 1 year at anniversary, and we will apply a return subject to that 7.25 cap. Okay, so again, more upside potential, but no downside risk. Okay. I'm not going to walk through all of these different allocation options. I just kind of want to give you a very basic feel of how they work in terms of annual point to points or 2 year point to points, caps, and participation rates. Okay. And I'll open this up for some questions also as we get closer. Okay. So in regards to our safety and accumulation product, that was our Performance Pro that comes with a large up to 15% bonus with strong caps and rates. Another example of a accumulation and protection product is our Accumulator Plus product. Essentially, the main difference between the two is this product does not get an upfront bonus like the Performance Pro. However, it does get higher caps and rates from year to year. As an example, as you can see there, our 1 year point to point is at 9% right down in this area. So 9% versus 6.5, right? So there's more upside potential. The client's just not going to get an upfront bonus. So you may be thinking, okay, which one's better? Which one's going to return more? Really, that's up to you and the client when you're looking at, what the best, what your preference is. A lot of folks that are going to move over, say, a 401k, if it's going to be quite a bit of money, like $100,000, they may want that big 15% bonus up front, even though it's going to come with a little lower cap. If you're starting a little lower in regards to the deposits, say $10,000, $20,000, you may want to forego that bonus because the bonus is going to be a lot lower, but you're going to have a lot more upside potential via that significantly higher cap. Okay. So from year to year, the client can make up to a 9% return by tracking the S&P 500. Again, significantly better than a CD or just letting it sit in the bank or something of that nature that's just as safe. Okay. As I mentioned early on in the conversation, these products are very competitive right now because of the interest rate environment. Just a few years ago, around COVID, shortly before, when interest rates were significantly lower, you would have seen products like this with caps probably around the 4 to 5% area. They're significantly more competitive now. So now is a great time to utilize these and to market these in your business. Okay. So basically, I know there's a lot of information there in terms of the indexes. So a lot of your questioning is probably, okay, which one should I utilize? Basically, what this is showing right here is that the best thing to do, and this is what I learned in business school, is to diversify, right? You don't have to put everything, all the eggs into one basket, whether it be the S&P 500 or that balanced asset or the gold commodity, any of those things. You can split them up, 20%, 20%, et cetera. You can split them up 3, 4, 5 ways, and you can change them around from year to year at every anniversary. So what this is showing here is that this is returns over 10 years of returns here, utilizing what's most of our index options there. As you can see, the S&P 500, the gold shares, several of our options within our products. There's a lot of colors here. There's a lot of numbers here. Basically, what this is saying is there is no one best option, right? From year to year, it kind of changes which one performed the best. Because of that, it's best to diversify across several of those options. Okay. I also kind of want to point out here, when you're looking at years 2015 and 2018 and 2022, see there's a lot of negatives there. Again, that is this product protecting your clients from downside loss. If they were just in the markets and stocks and their 401ks, they probably would have lost significant amounts of money in those years. This product is protecting them from the downside. So instead of losing 5, 10, even 20% of their investment, they just would have simply had a zero for the year. Again, protecting them from the downside, which is what a lot of folks are looking for right now. Some safety, again, with good upside potential in a product like an FIA, a fixed indexed annuity. Okay. What this shows basically is the more you diversify across the different allocation options, the percentage of positive interest credits, basically non-zero years, you're going to have much higher percentages or much higher chance of having positive years the more you diversify across several of those options. So again, this is basically all just saying, it's best not to put all your eggs in one basket in regards to helping your client to invest in the separate allocations within their annuity product. Okay. If you like, you can take a quick pick of that. If you are appointed with us, we have a whole bunch of fantastic marketing pieces. Here's some examples here that we can help you out with. We can get them to you. We can email them to you. We can mail them to you, and that you can help share and walk through this with clients. I know as a product, it can seem a little bit cumbersome and a little hard to understand, but here's what I just want to, kind of circle back to. The products, like we just talked about, the Performance Pro, and the Accumulator Plus, they're providing downside protection for clients and still providing very good upside gain potential. Okay. So even though it is an insurance product, it is acting similar to a financial investment instrument. Okay. Okay. So as I mentioned before here, there's two sides to the FIA annuity coin. One is safety and accumulation, which we just got done speaking to. The other side, which I'll just briefly note on here, is guaranteed income. Okay. Let's briefly talk about that. If you have folks that are trending towards retirement or at or in retirement, so their 50s, their 60s, 70s, etc., what are top of mind concerns heading into retirement today? Okay, if you have those sorts of clients. If you ask clients, hey, what is your number one concern when you retire? I guarantee you, probably 9.9 times out of 10, they're going to say, well, of course, running out of money, right? That's my biggest concern. And what that is called is longevity risk, right? That is folks outliving their money. It's fantastic that they live a long time in retirement, but are they going to have enough money before they run out, right? That's their biggest concern. So what we have here is a product, an FIA that provides essentially a lifetime guaranteed income stream. Okay. We have some pretty smart folks here that have done some research that basically says folks who retire, they typically are resistant to spending down their savings. They're worried about running out, right? Basically, when they purchase an annuity that includes a lifetime income benefit rider, it can allow retirees to spend their savings without the discomfort generated by seeing their nest egg shrink and get smaller. What does that mean? Basically, what that means is that we have a product where we can provide in retirement a guaranteed lifetime stream of income, basically very similar to like a Social Security sort of payment, where regardless of how long they live, how much, how long they take the payments, we are going to send them a calculated payment every month, like a paycheck for their income every year for the rest of their life until they pass away. How much are those payments? That's going to be dependent on obviously how much money they put in, how long they let it grow, and what age they are when they turn the income on. Okay. This product is something that most folks in the marketplace just don't know even exists. They think they'll have their Social Security, which they love, but it almost never is enough, right? Very few folks, under 10%, have some sort of pension unless they work for the government or something like that, where they're going to receive income for life. This product is the only product on the market, an annuity with a lifetime income rider, that can provide an income for life every single month guaranteed. Okay. Basically, what it does is it will grow over time. And again, dependent on how much money they put in. I'm going to flip to an example here. As an example, if they put $100,000 into our Safe Income Advantage product, which is our guaranteed lifetime income product, okay, and they turn on income after 1 year, and let's say they're 64 years old when they purchased it, they will receive $8,254 a year, which we can divide up into monthly payments if they want. $8,254 a year for the rest of their life to help pay their bills, right? It acts very similar to a Social Security payment, right? It's exactly what they want. They're worried about running out of money. It's always going to pay forever. Even if their account value goes to zero, even if they live to 120, it doesn't matter how old they live, they're going to receive that 8254 for the rest of their life. Again, that payment was calculated using their premium amount, the 100,000, how long they let it grow, which was a year, and their age when they purchased the product, which was 64. So they basically bought this product of ours when they were 64, they let it grow for a year, they retired, and then they turned it on. So this, in addition with their Social Security, is going to help them with their expenses, and they know they're never, ever, ever going to run out of it. Okay. When you sit down with folks and explain this to them, they you don't even have to say that it's an annuity, right? You can say, hey, what if I have a solution for you where we can get you a paycheck every month when you retire for the rest of your life, and it will never stop, no matter how long you live or how long it pays out. And 10 times out of 10, they're going to say, that sounds fantastic. Obviously, nothing like that exists. Well, it does. There's one product where it does exist, and that's an annuity with a lifetime income rider. Okay. So I just wanted to basically just show the very basics of how that works in regards to calculating them, a little bit more in depth of how they work. That's what our internal wholesaling team is for. We can walk through illustrations, things of that nature. Again, circling back here, FIAs can do two different things: safety and accumulation and lifetime guaranteed income. Okay. So with that here, I know we're kind of getting close here within about 10 minutes or so. I do want to just show again a couple of marketing pieces we can help you with. Basically, this here, a retirement income planning tool, what that does is that helps you figure out, hey, if you're looking to retire, how much income are you going to need when you retire? What are your bills going to look like? Let's get you what you need so you know how much money you need to put in. Okay. Things like that. So, with that said, I do want to show you, get you a phone number here. This is a number to our sales desk, our internal sales desk, where you can call in at any time. After this, as I mentioned at the beginning, I wanted to paint a very broad brushstroke of what an FIA is, what a fixed index annuity is, how it can be utilized, and how it can help your business practice. These things in regards to clients need them, they want the benefits of them. And it's our job, including you, to get this out there to the clients that these sort of things exist. And as you start building your business and selling products like this for these clients, you'll start making some very, very lucrative commissions as well. They pay some very lucrative commissions. So I would leave you with this. Fixed indexed annuities, safety, accumulation and protection on one side, lifetime guaranteed on the other side. How do we fund them? What sort of clients are you looking for? You're going to be looking for folks to either start one fresh at $10,000, or you're going to see a lot of dollars that you'd be looking for in 401ks, where folks are worried about downside risk and they're wanting to de-risk and get out of the market. Another example, as I mentioned before, would be clients who maybe have left a job and they have an old 401k out there that they need to do something with. A lot of 401k plans, they will make them move them, or they won't have control over how they're done. So you can help them move them over to a product like this, have downside risk protection, have good upside potential, and have them, make money over time for their retirement and have some good returns. Okay. So I know that was kind of a lot. So what I'm going to do is I'm going to pause here and I'm going to just kind of open it up for any sort of questions that you like in regards to how they work in general, all the way up to more specific questions in regards to the product.
Yeah, so I want to address really quickly. Someone said $8,200 a year. That seems like kind of small for only putting in 100K. Think about it
Mhm.
like this. $8,200, if they just took that cash out of their $100,000 account, they have 12 years and that's out of money. If that person was 65, they turned on that money. Now they're 77. Now they have nothing left. How many people do you talk to on a daily basis with final expense life insurance that are 77 and broke? We can fix that. Like we have the tools to fix that. I mean, at least where they're not negative every month. People will have space to actually have a couple extra things, be affordable at that age. And
Right.
obviously, if we're talking large amounts of money, we can have people, really securing an income for themselves, their spouse for their entire life, and that's really incredible. So instead of having your money last guaranteed for 12 years, if you have it in a savings account, we can guarantee it for the rest of their life, which could be an extra 40 years or so.
And that's curing what I refer to as longevity risk, right? People's number one concern is running out of money in retirement. As we know, folks are living longer and longer. There are a lot of folks out there that are going to live in retirement for 30 years or longer. Their money will not last. If they're just simply spending it down and needing to pull from it for 30 years. This sort of product it isn't meant to take all of their investments and put into it. It's meant primarily for a portion of it, right? A lot of folks will set up, hey, I want X amount, whether that be 10, 20, 30, $40,000 a year, or, to be able to pay for their fixed expenses, right? Their insurance, their Medicare, their food, their electricity, all those sorts of things. And then some of the other investments they can remain a little bit more aggressive with, and that's what they can pull some return on to have things like vacations and visiting the grandkids and things like that, right? So this is just basically a piece of their retirement puzzle, and it's the part that is guaranteed that they know they will never ever run out of. And when you're adding in their social security, a lot of folks will receive 15, 20, $25,000 a year in social security. If they're putting in a few $100,000 into an annuity, then we're going to be talking, then you're going to be talking about the two mixed together. That's where you're talking about 30, 40,000, $50,000 a year, just in income they're bringing in every single month that they know will never run out. And when they know it doesn't run out, they will actually spend their money, and they will actually have healthier, happier retirements because they know that check will never stop.
Awesome. Hey, let's get at least 5 questions. So just unmute, put it in the chat. Let's get at least 5 questions. Lonnie took his time out of his day. He's a really smart guy. Let's make sure we're maximizing our time here. So open up for questions. Come on.
I have a question.
What's up, Elijah?
Say you have a family member that has an annuity and they got it set up within like the last year. How
Mhm.
could I maneuver that into like switching it over to an F&G annuity?
So yeah, it's a very good question. I mean, we do allow for replacements. Basically, that would be called a like-to-like 1035 exchange replacement, an insurance product to an insurance product. Um, when I mentioned earlier that clients don't have underwriting like they do with a lot of health and insurance products. We do, however, do a suitability review. And basically, what that is we make sure that it's in the best interest of your client to be able to replace that older product. What does that mean? That would mean, hey, if they're looking for an income, we're able to get them an income. Maybe if it's not an income product, it's just a safety and accumulation product. Can we provide them better caps, a bigger bonus, more upside potential? If that's the case and we can show that, yes, we are able to do that. So basically, that's going to be on a case by case basis. What I would say is if the contract is at least probably 2 years old, that is kind of when a couple of years ago, that's when the interest rate environment started rising. So that is when caps rates on the accumulation side and when income amounts started rising, all those things started going up. So if you have a product that's going to be at least a couple of years old, more than likely it would be very ripe for a possible replacement simply because of the competitiveness of the annuity markets that where they are right now. So fantastic question.
Thanks, Lonnie.
Absolutely. And another thing to mention with that guaranteed income, as Rasan mentioned, the $8,000 may not sound like a lot, but when you go and you figure out the actual calculation, which is the amount of money, and then what there is there's a payout percentage that's applied depending on your age. That is actually very high for the industry. Like a lot of folks will say, hey, the old 4% withdrawal rule, I probably not better take, more than 4% a year. Otherwise, my money's going to run out. The payout percentages on these products are significantly higher than that 4% rule per se. A lot of payout factors for 64, 65, 66 year olds are north of 7%.
Couple questions here in the chat. So does that calculation include the bonus, or is it calculated on the amount that they set the annuity up with? I believe that's more based off of the guaranteed lifetime income.
The lifetime
So
guaranteed income, the safe income advantage, that product does not come with a bonus. So that there wouldn't be a bonus added on there. We're putting all of the investment dollars into the lifetime income. So what that's doing is an example of how you would calculate what your income is, and I can kind of back this up a little bit just to show you. Right here, the amount that goes in grows by 7.2% compound roll up rate. And then when they decide to turn it on, whether it's 1 year out, 2 years out, 3 years out, we apply a payout percentage depending on their age. The older they are, the higher the percentage payout is. Okay. So that's how it's growing. There's no bonus on the front, but it is growing at a very aggressive 7.2 compound rate. And that, again, that is the income account value. That's the number that's used to calculate the guaranteed income. And that does vary from the cash value. Once we
yeah.
get to the actual illustration here, it's the $100,000 time, with 1 year of growth at that 7.2%, times that payout percentage where we're getting $8,254. I hope that answers the question. Let me know if it does not.
Tate and all said if they add a lifetime rider, they still get paid even if that 100K runs out. Yes, that's the whole point.
Yep, that's exactly right. Yeah, and again, that's the number one problem in retirement or worry is folks running out of money. So if they have, let's say, $40,000 a year in income coming in, it doesn't matter, if it runs to zero in 10 years and they live another 25 years, the rest of that's on the company. We pay for that. They'll always receive that paycheck every month, regardless of when it runs out. So the short answer is yes, absolutely.
Yeah, and Tate, it might even like sound like, hold up a minute, like that sounds a little too good to be true. Like that's why these products are so powerful, is because like we can make what most people think is impossible just like reality. And we can give it to them in a very simple, easy policy that they can roll over whatever they have, tax-free, penalty-free, right into.
Kind of jumping back over to the accumulation side, you're going to probably find a lot of folks out there that again, that whether it's all of it or maybe just some of their investment, they're going to want a little bit more safety and protection, right? Having no downside risk and being able to make 7, 8, 9% or more in a given year is very strong and very powerful. Especially for folks that are getting closer to retirement or just can't stomach the ups and downs of the markets. If you have someone that's planning on retiring in 5 years and 2008 happens again, they're probably not going to retire in 5 years. That's going to throw a whole problem into their entire retirement plan, essentially losing 30, 40, 50% of their money with 5 years or less to retire. That's exactly the number one problem that they're trying to avoid. At that point in time is more important than a little bit more upside potential.
All right, then Ed Allen said if someone invests 100K, getting that 8K per year payout, what happens to the rest of the money if they die before the 100K is paid out?
Very good question. Yeah, I kind of mentioned towards the beginning that any leftover value does go to named beneficiaries. So if they do pass and there's still cash value within the product, it goes to their noted beneficiaries of record. It doesn't just go away or anything like that. Whatever's left in it that they haven't taken goes to their beneficiaries.
Awesome. So I know we're running a little bit long here, so I do want to just add for everyone that's on the call, there's two different ways. Not these aren't the only ways, but two ways you can start adding these types of pitches to your conversation on a daily basis. First, finding the money. The golden question you need to ask every single person you're talking to is, what do you have that acts as life insurance that pay out to your beneficiary if something happened to you? What do you have that acts as your retirement right now? If you're talking about people with IULs, I ask this every single sit I'm on. Awesome. Your goal with the IUL, it's tax-free retirement, more retirement focused. Awesome. Let me ask you before we get into anything, what do you currently have that is your retirement plan? What are you working with? And I break that down. Every single call, if it's final expense, what do you have that acts as life insurance? What's going to pay out? Just so I know how to help you the best. What's going to pay out if you pass away tomorrow? What do you have? Find the money. That's step A. Step two, that's just going to be now building some value on it. You don't want to immediately jump into an annuity pitch. Finish your life insurance sale, sell the policy, come back to it. Hey, by the way, before I let you go here, you mentioned you had this policy, you had this retirement plan. Now, let me ask you a couple questions about that. Now, it's just like a really, really easy pitch. And if I was able to show you a way where we could just protect that account from ever losing a dollar for the rest of your life, still participate in the market, and at the same time, even guarantee you a lifetime stream of income, like would that be beneficial? Would that be worth like 5 minutes of your time to look at? Yeah, okay, well, of course it would be. Like, yes, they're gonna get 9 times out of 10. Yes, if the other 10th person, they just didn't hear you right, they're not all there, right? Because it just makes sense, right? So that's as easy as you really need to do it. Would that make sense? Yes. Schedule an appointment with them. Get someone like myself, Wyatt, Cody, get someone on the phone with you that knows what they're talking about with an annuity and can talk to your client. And then just like that, you're going to have more annuity sales every single month. You don't need me to hop on a call with you every single time. You need it maybe once, maybe twice tops. And then you're going to see how the whole process is done. And you can just take over those calls yourself and start doing these completely independently. So that's what I want everyone to get into. And then if you ever ran into a problem where someone doesn't qualify for a whole life, or they're like, hey man, I don't know if it really makes sense. I'm like 65, I'm 70, I'm 72. I don't really think, spending $200, $300 a month on, that 20, $30,000 of coverage. I don't think that's going to make sense for me. Awesome. Have you ever looked into self-insuring? So this is another path to go down, self-insurance, because all that money they put away into these annuities pays out to the beneficiary tax-free, like a life insurance death benefit. It avoids probate. We name a beneficiary. It pays out to them upon the annuitant's death. That could be something where, awesome. So have you looked into self-insuring? What's that? No, I'm glad you asked. So something like that, we could actually take a certain amount of money you have in a retirement account, a savings account, an investment account sitting in the bank. We can use that to actually fund your life insurance. And what I mean by that is you wouldn't have to pay anything for life insurance. We'd be able to use your money to, first of all, pay out tax free upon your death, but while it's sitting in that account, it's growing every single year based off the market performance. And we can't lose a dollar of it. So your beneficiaries are guaranteed to receive at least, that 30,000, the 100,000, that 200,000, whatever that number is, they're going to receive at least that amount guaranteed, right? And anything we grow in that account, that'll also pay out to them. And if you wanted to look at guaranteed lifetime income streams, we have a good conversation about that. But like, there's so many opportunities in your daily phone calls that you could be pitching these to individuals on multiple levels, right? So self-insurance, portfolio insurance, you have X amount of products, you have an IRA, you have a Roth IRA, you have whatever it is. You have these stocks. What if the market crashes? Your 401k, like could you really suffer a 10-20% hit all across the board? No. Well, why don't we have some portfolio insurance? Have this type of account to protect you from downside. Not saying you should put everything into this account, but wouldn't it make sense to protect a portion of your money from market loss while still making money in the market? Like, would that be beneficial for you? So, like, start asking these questions to the people you're talking to. Get serious about this business, because these types of products, when it comes down to annuities, IUL sales, like these are where the real big money is at, right? Obviously, with final expense, the volume of that will get you paid. Like, I'm talking you're writing 3 to 5 apps a day. You're writing 2 to 3 apps guaranteed every day if you want to make some, 30K a month income with final expense. That's exhausting after a couple years. That's exhausting. But with annuities, if you can just start learning these products and getting it down that this is where you want your business to be headed, is having these consistently in your agent's production and your own production, you're going to have a really strong source of cash flow that you will not get exhausted from. I can guarantee you that. But I appreciate you guys for hopping on. Lonnie, thank you so much for taking the time to hop on with us, man. I really appreciate it, man.
Yeah, thanks,
Absolutely,
Lonnie.
absolutely, my pleasure, my pleasure. And again, we also have our that 800 number as well. We have a dedicated team to help you. Everybody starts somewhere, and we have some very, very, very successful folks helping their clients and making a lot of money while doing it. So best of luck to you all, and thanks so much for your time.
Thank you guys. All
Fantastic.
right, everyone, I'm gonna
Thanks,
have this
Lonnie.
uploaded on the YouTube, where I'm uploading everything by the end of the day. So I'll put that in like the Discords, the group meets, whatever, so you guys can watch it back. But thank you guys.
Next
God bless you. I'll
next
talk to you
week,
soon.
next week we'll be doing IULs, and then following week I'm gonna try to have a theme get on and for annuities that week, and we'll keep doing it week after week. So get people on and let's start selling IULs and annuities. Thanks, everyone.
Guys, our goal is to get these calls to 200 plus people. We're having about 50 to 100 on a week to week basis. Let's figure out all together how to get these to over 200. Whether that means you're getting the rest of your team on, you're getting, whoever you can on here to learn about how to increase their business. At the end of the day, that's what we all want. We want to make more money, build a stronger business, help more people. A way we could do that is by selling annuities at a high level, because not only are you going to be able to get paid more, but you can use that money to reinvest back into your agents, your business, your lead flow, your marketing. And that's going to help you all around build a stronger, more. It's going to build you longevity in your business. So I appreciate you guys. Next week is IULs. Let's pack that call out. Let's get to those 200 people, and God bless you guys. Have a good rest of your day.